Welcome back to Options Guide, where we cover the real-world aspects of trading that most channels ignore. I'm your host, and what we're discussing today could be worth more to your bottom line than any trading strategy. Tax efficiency is the difference between keeping 60% of your profits and keeping 85% of your profits. That's a massive difference that compounds over time. So grab a pen and paper, because we're about to dive into the tax code secrets that separate smart traders from everyone else. Basic options tax treatment. Let's start with the fundamentals. The IRS treats options as capital assets, which means your profits and losses are generally treated as capital gains and losses. But here's where it gets complicated. The tax treatment depends on what you do with the options. Scenario 1. Buying and selling options. When you buy an option and sell it before expiration, it's treated as a capital gain or loss. If you held the option for more than 1 year, it's a long-term capital gain, taxed at preferential rates. If less than 1 year, it's short-term, taxed as ordinary income. Example, you buy Apple calls for $500 in January and sell them for $1,200 in March. That's a $700 short-term capital gain, taxed at your ordinary income rate, potentially 22 to 37% for high earners. Scenario 2. Options expiring worthless. If you buy options that expire worthless, you have a capital loss equal to the premium paid. If you sell options that expire worthless, you have a capital gain equal to the premium collected. Scenario 3. Exercise and assignment. This is where things get tricky. When you exercise a call option, you're buying stock at the strike price. Your cost basis in the stock includes both the strike price and the premium you paid for the option. Scenario 4. Assignment on short options. If you're assigned on a short call, you're selling stock at the strike price. If you're assigned on a short put, you're buying stock at the strike price. The premium you collected adjusts your cost basis. Wash-sale rules and how they affect options. The wash-sale rule is one of the most misunderstood aspects of options taxation, and it can seriously mess up your tax planning if you're not careful. What is the wash-sale rule? If you sell a security at a loss and buy a substantially identical security within 30 days before or after the sale, the loss is disallowed for tax purposes. The loss gets added to the cost basis of the new position. How this affects options. Scenario 1. You sell Apple stock at a loss and buy Apple calls within 30 days. This triggers the wash sale rule because calls are considered substantially identical to the stock. Scenario 2. You sell Apple calls at a loss and immediately buy different Apple calls, different strike or expiration. This generally does not trigger wash sale rules because the options aren't substantially identical. Real example, January 15th. Sell 100 shares of Apple at $150, cost basis $170, equals a $2,000 loss, January 25th. Buy Apple 160 calls for $500. Result, the $2,000 loss is disallowed, and your cost basis in the calls becomes $2,500, $500 plus $2,000 disallowed loss. How to avoid wash sales. Wait 31 days before buying back similar positions. Buy options with significantly different strikes or expirations. Consider using index options instead of individual stock options. Record keeping for wash sales. Your broker should track wash sales, but they often miss complex scenarios involving options. Keep detailed records of all transactions and consult a tax professional for complicated situations. Tax-efficient option strategies. Now let's talk about specific strategies you can use to minimize your options trading taxes. Strategy 1. Hold long options for over 1 year. If you're buying leaps or long-term options, try to hold them for more than 1 year to qualify for long-term capital gains treatment. Strategy 2. Use index options for short-term trading. For day trading and short-term strategies, use SPY, QQQ, or other index options to get the 60/40 tax treatment. Strategy 3. Tax loss harvesting with options. Use options losses to offset other capital gains. You can realize up to $3,000 in net capital losses against ordinary income each year. Strategy 4. Qualified covered calls. If you're selling covered calls, make sure they qualify as qualified covered calls to maintain long-term capital gains treatment on your stock. Strategy 5. Retirement account trading. Consider doing your most active options trading in tax-advantaged accounts like IRAs, where you don't pay taxes on gains until withdrawal, traditional IRA, or never, Roth IRA. Record keeping and documentation. Proper record keeping is absolutely crucial for options traders, and it's where most people fail. The IRS requires detailed documentation, and your broker statements often aren't enough. What you must track: date and time of every transaction, strike price and expiration date, premium paid or received, quantity of contracts, opening and closing transactions, assignment and exercise details, wash sale adjustments. Recommended tracking system. Create a spreadsheet with these columns: date, symbol, action, quantity, strike price, expiration, total cost or proceeds, P&L, tax treatment, notes, software solutions, TradeLog, specialized tax software for traders, TurboTax Premier, handles basic options transactions, TaxAct, good for complex trading situations, Excel or Google Sheets, DIY approach with templates, special situations to document, constructive sales when options positions create tax consequences, straddles and their tax implications, Section 1256 mark-to-market adjustments, wash sale adjustments and carryovers, year-end tax planning, review unrealized gains and losses, consider harvesting losses to offset gains, plan for mark-to-market consequences on Section 1256 contracts, organize all documentation for tax preparation, consult with a tax professional for complex situations. Common tax mistakes and how to avoid them. Mistake 1. Not understanding assignment tax consequences. Many traders don't realize that assignment creates immediate tax consequences. If you're assigned on a short call, you're selling stock and may owe taxes immediately. Mistake 2. Ignoring wash sale rules. Traders often trigger wash sales without realizing it, especially when trading the same underlying with different strategies. Mistake 3. Poor record keeping. Relying solely on broker statements without tracking the details needed for accurate tax reporting. When to hire a professional, you're making more than $50,000 annually from trading. You're using complex strategies like straddles or conversions. You have wash sale situations you can't figure out. You're trading in multiple account types, taxable, IRA, etc. You're a full-time trader considering trader tax status. Mistake 4. Not planning for estimated taxes. If you're making significant profits, you may need to make quarterly estimated tax payments to avoid penalties. Quarterly payment dates. Quarter 1. April 15th. Quarter 2. June 15th. Quarter 3. September 15th. Quarter 4. January 15th following year. Final tax tips. Keep all records for at least 7 years. Consider the tax impact before making trades, not after. Understand your broker's tax reporting capabilities and limitations. Stay updated on tax law changes that affect traders. When in doubt, consult a qualified tax professional. The strategies we covered today, using Section 1256 contracts, avoiding wash sales, proper record keeping, and tax-efficient trading, can save you thousands of dollars every year. Remember, tax planning should be part of your trading strategy from day one, not something you think about at year-end. The most successful traders are tax-efficient traders. If this tax guide opened your eyes to opportunities you didn't know existed, smash that like button and subscribe for more real-world trading content. Comment below and tell me, what's your biggest tax challenge with options trading? Or share a tax mistake you've learned from.